Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. What if I told you that the U.S. government is now stepping into the bond market to support the price of its own debt? And here's the problem, the market isn't exactly listening. The United States has crossed the $40 trillion debt mark, while the 30-year Treasury yield recently pushed above 5%. On August 19th, the Treasury announced it would at least double the size of certain long-term bond buybacks from $2 billion to at least $4 billion per operation. And that's going to start next month on the 9th. So today we're going to answer a couple questions. Why is the Treasury back long-term bonds in the first place? Why are investors demanding higher yields on government debt? And what does this mean for financial markets and your wallet? Before we get into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdown, like, subscribe, and share this with somebody who is into this kind of content. Now let's get into the video. So think about the Treasury market like a giant auction. The U.S. government needs to borrow money, so it sells Treasury securities to investors. Normally, investors buy them because they're considered among the safest assets in the world. But here's the catch. When investors become less comfortable holding long-term government debt, they demand a higher interest. They demand higher interest rate. When the yields go higher, bond prices go lower. It's an inverse relationship. That's exactly what we're watching right now. The 30-year Treasury yield recently climbed above 5%, reaching levels it hadn't seen since 2007. That creates a problem for the government because higher yields means higher borrowing costs. So the Treasury announced a bigger buyback program targeting longer duration securities in the 10 to 30-year range. The stated goal was to improve liquidity in those markets. But the markets immediately started asking a much bigger question. Is this simply a technical adjustment, or is the government becoming increasingly concerned about long-term borrowing costs? And that takes us to the real problem. So the United States has crossed the $40 trillion national debt. That number is enormous, and it's a little difficult to put into perspective. But here's the important part about all of that. The government doesn't just owe the money. It has to refinance the debt and pay interest on it. And when interest rates stay higher, that becomes increasingly expensive. So the Congressional Budget Office, and you got other fiscal analysts, have warned for years about the growing burden of the federal interest costs. And now we're seeing the markets focus directly on that problem. Because investors aren't just asking, will the U.S. pay me back? They're asking, at what interest rate do I lend to the U.S.? For 10, 20, 30 years? That's a different type of question. And here's where things get even more interesting. If policymakers push interest rates dramatically lower while inflation remains elevated, investors could demand even more compensation for holding long-term bonds. So the government has a problem from both directions. Too much debt pushes borrowing costs higher. Too much inflation makes it harder to push those borrowing costs back down. And that creates what I would call as a policy squeeze. So here's the part that a lot of people miss. You don't have to own a Treasury bond for Treasury yields to affect you, okay? The reason why because influence lots of money across the entire economy. You got to think of it in terms of it affects, mortgage rate, corporate borrowing, it's the credit markets, valuation. Even government costs are affected. So if the 10-year Treasury yield moves significantly higher, that can eventually show up in the financial decisions of ordinary people. Imagine you trying to buy a house. If mortgage rates rise, your monthly payment can increase dramatically, even if the price of the house doesn't change. Now imagine your company deciding whether to build a factory, hire workers, or issue some debt. Higher borrowing costs can make the investment less attractive. And that's why this isn't just some bond market story. It's about the price of money more than anything. So here's a bigger question. Can Treasury buybacks stop yields from rising? The answer is they can help, but there are limits. When the Treasury's additional demand for those securities, some demand can push bond prices higher. And because bond prices and yields move in opposite directions, higher prices can push yields lower. That's the theory aspect of it. And initially, that's exactly what happened. After the August 19th announcement, long-term Treasury yields fell, but the relief was short-lived. The 30-year, it climbed right back up to 5%, above 5%, showing that the underlying forces pushing yields higher hadn't gone away. And that's the key distinction. A buyback can change the demand for bonds. It doesn't automatically change the government's fiscal position. It doesn't eliminate 40 trillion of debt, and it doesn't force pension funds, insurance companies, foreign investors, and other institutions to suddenly love or fall in love with 30-year treasuries. That's why investors are watching what happens next. Because if the Treasury has to keep increasing the size of its intervention just to keep yields from rising, the market could start asking a very uncomfortable question. How much intervention is enough? Quick pause, guys. If you want more breakdowns like this, please hit the like button, share, turn on your notifications so you never miss a video. Now let's bring everything together. The Treasury has announced larger long-term buybacks beginning September 9th. The size will be at least $4 billion per operations, double the previous maximum. But the government's debt burden is still out of control. Inflation is still above the Fed's long-run target. And the bond markets has already shown one intervention doesn't necessarily change the larger trend. The Treasury can buy back bonds, that can change monetary policy, but neither one can permanently override supply and demand, inflation, and investor confidence. Eventually, the bond market has to decide what rate it wants. And right now, that market is demanding a higher price for lending Americans money over the long run. So here's the question I want to ask you. Is the Treasury buying time, or is the bond to call its bluff? Let me know in the comments. If you enjoyed this breakdown, please like the video, subscribe to Economics 101, and I will see you on the next video. Thank you for tuning in.